All right, another Saturday, another portfolio update and review. So let's take a quick look at the last week and our positions, Greeks and such. So at the moment, we are looking at 54 in Delta, which is getting close to our max, but still in line. Buying power pretty low at 17.7, still in line. Theta slightly on the low side, but still getting us ahead nicely. And we have 15 positions open. Our plan says we should have maximum of 16, so we are good there. Last week, last week here, the red, that's 3 trades. We had 3 trades last week, so that's the max for that week. We're gonna get to put some new ones next week. And the net leak is 39,596. So let's take a look at the performance overall. Here on the left hand side, you see it from inception when I started tracking on the let's see the date, on the end of May last year, and then in the blue here, this is year to date. So once we put in the numbers, we can see that, and here on the right hand side we have the graph for both year to date and the overall performance. So year to date, we had a nice week last week. So did the market. It went up, and so did we. We're fine there. Overall performance, we are ahead of the market quite a bit, so we're happy there. And if we take a look here, projected yearly return is back in line at around 24%. We had a little dip last week when the market went down, and we went down as well a little bit. But everything is in line. Everything is the way we would expect, and we're happy with that. Now, the VIX is on a low side at 13 and change. So we don't want to overload on positions or anything, and we want to make sure that we have the buying power available once the VIX increases, which might happen next week or a couple of months, but it sure will happen. Let's take a look at the positions that we did last week. So here we can see on the 13th and on the 12th, that's last week, we closed 2 positions, both for profit, 138, 129. Accordingly, the put debit spreads are stayed open. We didn't close them. There's very little value in them, but you see, we still have now 5 put debit spreads without any naked puts attached to them. So they're providing a little bit of extra hedge, if you will, and they're not costing us much. There is no point in closing them for just capturing a couple of dollars. So it's better to just leave them as they are. We opened 3 trades here, 11th, 12th, and the 13th, 3 of the 1-2-1s, and that's it. There we spent around 25% of our collected premium on naked puts on the PDS itself, and I think they're all in the same 80, 71. Not the naked puts. These 2 are in the same DT, same expiration date. Yeah, so 76. So we have some here, and we have a few in here. All right. Now we still have, if you go to positions, we still have few of the call spreads, 1, 2, 3 of them. They're all in the money, meaning they're losing money, but this is all fine. Let's take a look here. So we have these 3 trades open. All of them are pretty close to the max loss, but we're not going to be closing them because there's very little left in them for us to lose, but they're providing nice balance and a little bit of negative delta, which is what we need to have. There is maybe $15-20 in each of them roughly, but a good thing about these call credit spreads is that should the market go down a little bit, they would be gaining more negative delta, which is what we need at a time when the market is going down. So let me just demonstrate that here. For example, let's take this one. And let's just go pretend we're going to close it. And so this is the one right here. Let's clear this real quick. So as you can see, the market went straight through them, and the two of them are providing 2.5 in negative delta. You have to multiply this by 50. So 0.05 times 50 is 2.5, right? So imagine if the market goes down, that means that these strikes would be getting closer and closer to the money. They're staying 60 wide. Just make sure that they're staying, so they should stay 60 as they were. So now you can see here that negative delta almost tripled. So if the market starts to go down and getting closer to our core credit spreads, they would be gaining negative delta. That would improve our position. It would balance our account a little bit. So we're not worried about losing money on them. They're meant to be sort of a loss leader, if you will. But overall, over a long period of time, they will probably break even roughly. And the thing is, we will be losing money on them when the market is going up, and which is fine because we're gaining, we're making profit on our naked puts, and they will be gaining money or making money for us when the market is going down, which is the time when we're losing money on naked puts. So they're providing a stabilizer for the whole account, but overall they should be close to breaking even because we're putting them on roughly at a 50-50 chance of making any money. We're putting them close at the money, which is roughly a 50-50 proposition. So we're fine. Everything is looking good. Let's take a look. No, actually, I think we already checked the Greeks. So I'll be going on holidays next Friday in a few days. So I'll be lightening up on the positions a little bit. I don't want to be overloaded because I'm going off grid and might not have internet access all the time. And so I don't want to be worrying about positions if I don't have internet for some time. So I'm just gonna lighten up a little bit, but that shouldn't hurt the account too much, hopefully. All right, guys, thank you very much, and have a great weekend.